the expert.
No, please hold your thunderous round of applause. Good evening, everybody.
Good evening.
A little delayed. Let's try this one more time. Good evening. Much better, much better. I'm Russell Marsan, Senior Vice President with Investment Property Exchange Services. We're the largest qualified intermediary in the nation. That's all we do is 1031s. I've been doing it for 29 years. I am your local, personal 1031 resource. We're only together tonight for less than an hour and a half, not a long time period. Let me be very clear. Everything I say tonight, you don't have to remember a single word. What is the one thing you should remember?
Your name and phone number.
Thank you. My phone number. High five. Yes, it's right here. It's right here on the literature on the front. That's my cell phone number. You can reach me anytime at that number. If you call me at like 8 o'clock on a Friday night, the first thing you don't have to say is, Russell, I'm so sorry for bugging you at 9 o'clock on a Friday night. I'm a financial tax nerd. I have no life. You'll be giving me life by simply calling me and asking me tax questions. And my Friday night's a bucket of popcorn on the dining room table. My phone's right next to it. I'm eating popcorn, waiting for your call. So you can call anytime. I also teach accredited courses for CPAs and attorneys. So I'm a free resource for your legal and tax advice. Also, first and foremost, this is, like I said, this is the most important thing to remember. This is my contact information. If you don't want to type me into your contacts, put your camera on the QR code there and it'll download me into your contacts. So let's talk about what is a 1031 exchange. Who can just throw me out a single answer? What is a 1031 exchange? Anybody got a short answer?
Exchanging one property for another without a capital gains tax.
So deferring the tax. Yep. This is the way that I like to describe it. So a 1031 exchange allows a real estate investor to reposition their real estate assets throughout the course of their entire life without having to pay tax. Right? As you grow in life, your financial objectives are going to change. It's just a natural evolution. When you're young, you're trying to build wealth. So maybe you buy real estate that's primarily designed for appreciation. But later on in life, you own a bunch of real estate. You've built equity, you've built wealth. Now it's time to pivot to cash flow. It's a different kind of asset, right? Or then maybe later on in life, you're tired of the headaches of owning real estate. So now you want to go passive. Those are all different financial objectives. The 1031, as your objectives change, allow you to pivot to that type of property without having to pay a tax. So therefore, you're moving all of that equity forward with you. You're not having to give up that tax. So you're building more equity, more cash flow, more appreciation, etc. Right? It is the greatest wealth building tool in the entire Internal Revenue Code. Nothing else in the Revenue Code allows you to do what Section 1031 does. But it's an underused section code. Here's a question I ask a lot of people, and that is, hey, are you going to be doing, you're going to be doing a 1031 exchange? And they'll say something like, well, no, I'm not going to do an exchange on this one because I've already calculated the tax in my own mind, and it's not that much. There's two glowing red flags in that statement. What is one?
I did it myself.
Thank you very much. I calculated the tax in my own mind. I work with clients all the time that have owned real estate for 20 or 30 years. They're selling for the first time. If you haven't sold real estate in 20 or 30 years, you are not familiar with taxation, I promise you. A lot of people think, well, if I sell, I'm just going to pay 15% capital gains, especially in a state like Nevada that doesn't have a state tax. Let me be very clear. It's physically impossible to sell an investment property and only pay 15% in tax. It's not possible because there are many layers of taxation. By the way, you have a question?
Yeah. The 1031 versus like cost segregation, as far as like deferring taxes, could you speak to that? And then my other question would be, if you cost segregate something and then do a 1031 exchange on it later, is there a recapture at that point? Or?
Yeah, cost segregation, that's a pretty complex question. Is everybody familiar with cost segregation? Cost segregation is a way, and by the way, it's not versus 1031, because a cost segregation is not a tax.
As far as like tax deferral.
Cost segregation does not defer taxes. Cost segregation allows you more accelerated depreciation. It allows you to write off more each year. It's not a deferral of taxes. It's a tax write-off. It's an additional benefit because when you buy just traditional real estate, like residential income properties, the depreciation schedule is 27 and a half years. Commercial, 39 years. So maybe somebody owns a commercial property and that 1/39th of the assessed value of the improvements is not enough to write off against the income. So I want more depreciation. That's when you do a cost setting, right? And you're going to hire an engineering firm to do that, and they're going to pull out the value of the personal property, most like the electrical, the HVAC, all that stuff. And let's say it's a $5 million property, and they figure out that $2 million of that can be put into cost segregation. So now that $2 million, instead of being depreciated over 39.5 years, it's depreciated over 5, 7, they're much shorter. So you get a lot more depreciation to write off against the income.
So you're breaking up personal property from the real property?
It's still real property. It's just kind of a quasi. There's real property, 39.5 years, or 39 years and 27.5 years. That's a 1250 schedule for depreciation. 1245 is the cost segregation, right? And that's accelerated depreciation. It's still real estate, but it gets funky in like kind.
Like a refrigerator or something.
Not really a fridge. No,
like
not a
a
refrigerator. That's different. That's a personal property component. That's not real property. That's not real property. Okay. So, but what you're doing is taking real property and you're depreciating a portion of it on a faster schedule. Okay. So when you sell that property in the future, to answer your question, you have, in order to be like kind, you just converted 1250 to 1245. So the property you buy has to have 1245. Otherwise, you're recaptured on that. So you got to buy a property that also has cost seg. Otherwise, you can't transfer the basis of that into the replacement property. And cost seg, 1250 depreciation straight line, that's taxed, and we're going to talk about that now. It's taxed at 25% to the feds, right? Anything that's 1245 is just ordinary income. So you don't get the benefit of the lesser tax bracket. But let's just get into taxes, because I don't want to spend too much time on this. So here's the actual how taxes break down. There's really 3 layers of taxation when you sell real estate. One is capital gains. Capital gains is based on the appreciation of an asset, right? You bought it for $550, you sold it for $750, it appreciated by $200,000. That's capital gain. That's taxed at 15 to 20% to the feds. Whether you pay 15 or 20% depends on your adjusted gross income, right? Now there's another tax. I call it the hidden tax. And that's because people are not familiar with it unless they've somehow been impacted by it during their life. It's called recapture of depreciation. Right? We all know it. We just talked about depreciation, right? Fantastic benefit depreciation. Let's say I buy that $550,000 rental property and I depreciate it over 27.5 years. That's probably going to be around $15,000 a year on an asset that size. So that's wonderful. I have a $15,000 write-off against the first $15,000 of rental income. That negates the income tax due on that. That's a great benefit tax-wise. But every year I'm taking that depreciation, I'm lowering my cost basis on the asset by that amount. Right, so if I owned it for 10 years, I've taken $150,000 of depreciation. So if I bought it for $550 after 10 years, that ain't my basis. My basis is $400,000. Right? It appreciated by $200,000. So when I sell it, this is taxed at 15 to 20%. This is also taxed. They recapture the depreciation. That's a flat rate of 25% to the feds, no matter what your income tax bracket is. If you do cost segregation, that's taxed as ordinary income on that. So this is why, if you sell an improved property, physically impossible to only pay 15% when you sell a property. The last tax is the net investment income tax. That's more commonly known as the affordable health care tax. That's a federal tax of 3.8%. So when you blend all these together, you can see it's physically impossible to pay 15% in taxes. So let's do a little math equation here. So who here, by a show of hands, who here was my math major in college? Let me ask a second question. Who here took math in high school? Okay, sir, what is your name?
John.
John, thank you for volunteering.
I've been called worse.
Okay, thank you for volunteering, John. You are now our mathematician. You're a mathematician for tonight. Okay, so John, you're now my real estate agent.
That could happen.
That could happen. Okay, so what I own a property free and clear. I'm going to sell it for $1 million. I don't want it anymore. Right? My primary financial objective in life is appreciation. I think that area is not going to appreciate. I think it's capped out for the next 10 years. But I have designate another area. I think that place is going to explode in the next 10 years. So I want you to list and sell that property for me, help me buy replacement properties in this area. The first example, we're not going to do an exchange. I've fully depreciated the property. I've owned it forever. So let's say my net total tax is around 25% between everything, right? What I'm going to do is, with the proceeds from that sale, I'm going to use that as a down payment to buy a bunch of replacement properties. I want to buy as much as I possibly can because I'm going after appreciation. So I'm going to leverage myself out. The monies coming out of the relinquished property sale are going to be a 25% down payment on what I will get is on a 75% loan to value ratio to buy my more expensive property. Everybody tracking? Perfect. So when I sell for $1 million, the first scenario, I'm not going to do an exchange. So I have to set aside 25% to pay my taxes. John, that's the big question. What is 25% of $1 million?
250,000.
Give him a round of applause. Math under pressure. Very good. Very good. That is correct. That is $250,000 that I just said goodbye. That will never earn me one more penny of income. That will not grow and appreciate for the rest of my life. That might be, if you compound that number out for now and the rest of my life, that might be $1 million. It won't be part of my portfolio because I paid it today. Okay, great. How much does that leave me as my down payment?
750.
Oh, now you're all math majors. Okay, so 750. With that as my 25% down, I can buy $3 million. That's nice. Sold for $1 million, bought for $3 million. Cool. Now let's do the same thing in an exchange. If I sell and do a 1031, how much do I have to set aside? 0. I don't have to pay any taxes. We're making the math easy for Russell. Okay. So commission's correct. I've got $1 million as a down payment with the same loan to value ratios. I can now buy $4 million. Right, so I can buy $4 million instead of 3 just because I did an exchange. Obviously, this is an extreme example, right? But no matter what, the numbers always work out. The math always works. No matter what, you're going to be moving money with you. This is just one scenario. I'm doing this all the rest of my life. All the buying and selling I will do. You can imagine how much larger my nest egg will be when I go to retire because I didn't pay my tax, right? Still, with this knowledge, some people will still say, nope, I'm not going to do an exchange. And I got this a lot just prior to the election. A lot of CPAs were telling their clients, don't do an exchange. Just pay your tax. And because prior to the election, there was a lot of talk of capital gains going up, right? Because in a 1031, are you eliminating the tax? No. No, what are you doing? Deferring. You're kicking the can where? Down the road, right? So the thought process is, if they're going to be going up, why not pay them now when they're low? Because eventually, we're going to have to pay them. And of course, the client believes that. Because everybody in this room, including myself, we've all been patterned our entire life to believe that there are 2 things in life 100% inevitable. What are those 2 things? It's like you guys practiced it. Yeah. Yeah, we've been lied to. Only one of those is actually inevitable. Which one? Taxes. He's our speaker next month. He's going to tell us how to avoid debt. Fantastic. Taxes are not inevitable. They're not. Current estate tax law is incredibly favorable. Right now, current estate tax is that, $14.99 million. If you are single and your estate is below roughly $15 million, there's no estate tax. And your heirs get a step up in basis. If you're married, double that amount. Almost $30 million. No estate tax. And your heirs get a step up in basis. The step up in basis is the super cool part. Let's say I bought a property in Reno 60 years ago for $100,000. When I pass away, it's worth $2 million. If I would have sold that during my life, I would have paid taxes on $1.9 million a gain. That's a lot. My kids don't have to. They get a step-up basis to the fair market value as of the date of my passing. So let's say that I pass away yesterday, which makes this class kind of awkward. So I passed away yesterday. My kids go on title of the property today. Right, their basis in the property was stepped up to $2 million. They're going to immediately sell it for $2 million. They don't have a tax consequence. They don't need to do an exchange. It's as if they bought it yesterday and they're selling it today. There's no tax consequence. They can do whatever they want with the money. They don't have to buy other real estate. It's just tax-free sale. So that's why we say, don't cash out of real estate. Instead, just exchange into something else. I promise, people sell real estate because they don't like it anymore. It's not meeting their current financial objectives. Okay, great. I promise you, whatever your financial objectives are, there's an asset class in real estate that will absolutely meet those objectives. So don't just cash out. Instead, exchange until you die. We call it swap until you drop. Very good.
It's called the Die to Win program.
The die to win. Yes, absolutely. Any questions on estate tax or taxation? I think we're moving past it. Okay, very cool. Let's talk about just very basic rules of 1031, and we move these relatively quickly. So you have time frames in a 1031 exchange, right? You have 45 days to identify, 180 days to close. Both of those time periods begin at the closing of the relinquished property. So when the one you're selling closes, that starts the clock. Right now, that's what starts the clock. When do you have to have the exchange set up by?
179 days.
No. It has to be set up before you close. The exchange has to be set up before you close. So, because if you close, and I get this question a lot. I'll have clients call me and say, "Hey, Russell, I'm doing an exchange. My realtor said to give you a call to set up the exchange." I'm like, "Great. Where's your escrow at?" And they'll say, "Oh, it closed last week." My realtor told me that it'd be easier to do an exchange after it closed. I would never say this to the client.
It wasn't me.
No, it was not Ginger. In my mind, I'm thinking that realtor is about to be known as defendant because they just caused a great tax consequence to my clients. It has to be set up prior to closing. We can't set up an exchange until you're under contract with a buyer and you've opened escrow on the relinquished property you're selling, right? Now, when should I be talking to you? Way in advance, right? I don't care if you're selling 5 years from now. Call me. I want to make sure you go into that transaction stress-free, completely understanding your options and knowing what your priorities are. And that's my job. But we don't officially open the exchange until you're in escrow. And then we have to have it set up before it closes. It can be any time. You need the day before it closes. We don't like to do that. It's called a rush. We'd like some time to set up the exchange, but it only takes like a day to set it up. And then once it closes, boom, clock is started. Can't be stopped. Can't be postponed. Can't be reset. You are now, and by the way, the 45 and 180 day deadlines are calendar days. They're not business days. So if one of those falls on a weekend or a holiday, it's still that day. No exceptions. That's not 100% true. There are extensions granted for federally declared disasters. 9/11 was the first extension ever granted in the world of 1031. 1031's been around for over 100 years. That was the first extension ever granted because after 9/11, you couldn't fund a loan for a week. So Congress said, okay, great, we're issuing 120-day extensions for 1031 exchangers. That's 120 extra days to identify, 120 extra days to close. Since 9/11, now every federally declared disaster gets an extension. To qualify for an extension, you have to be what's considered an affected taxpayer, which typically means you live in one of the counties named in the extension. It doesn't mean you lost a property. It doesn't mean you were evacuated. It just means your primary residence is in one of the counties or states named in the disaster relief notice.
Your primary residence or the property
Your
you're
primary
selling?
residence.
Okay.
Not the property you're selling, the primary residence, right? So it doesn't, you can live here, right? But you could be selling a property in Florida and buying a property in Washington. It's where you are that gets the extension, right? Not where the properties are located. So if you do need more time, if you need an extension, what can you do?
Call you.
Move to Florida.
Call you.
Well, you can create a federally declared disaster.
Okay.
Right? You're probably going to go to jail, but you're going to save a lot of money in taxes. Very good. So,
Yeah, but the lawyer's fees.
so any questions on, yes?
What if you begin the exchange and all your replacement properties like go to someone else? can you cancel it at that point and pay your taxes, or you have to wait till the end of the 180 days to?
Good question. So I'm going to address two things there. One is, when can I change my identification? Prior to midnight on day 45, you can change your identification all you want. You can add, revoke on your list, whatever. But as soon as midnight strikes on day 45, you can only close on something you've identified, right? Now, if you cannot close, or if you decide to back out of an exchange, or if you don't find suitable replacement properties, right, and you want your proceeds back, once your relinquished property closes, you're now in the exchange. We are holding funds for you. We are governed by the IRS Treasury regulations. They're called the G6 Treasury regulations that stipulate how we have to act in order to be considered qualified as a qualified intermediary. One of those guidelines states that we cannot release the funds directly back to an exchanger. We can release them to any closing anytime. We can't give them back to the taxpayer until the exchanger can no longer complete a 1031 exchange. So when you're in the exchange, the earliest you can receive funds back is on day 46. Because by day 45, if you didn't identify anything, then on day 46, your exchange fails. You can't complete an exchange. So we can release funds to you on day 46. If you've identified properties and you've gone past the 45th day and you're not going to close on those properties and there's funds left over, you've identified properties. You can't edit your identification after day 45. So the IRS says you can still complete an exchange because you have outstanding identification. So we can't release funds until day 181. That's a 4.5 month difference. Right? So I like to counsel with the clients and make sure, hey, if you're going to go past the 45th day, because hopefully you won't. Hopefully you'll complete your exchange and close on it before day 45, therefore never putting your exchange in jeopardy. But if for whatever reason you're going to go past the 45th day, then we should talk prior to day 45 and make sure that you want to identify backup properties, right? Because that's a long time period to be without that money. Yes?
What does identifying properties mean?
So when you close escrow on a relinquished property, when you sell, you're now in the exchange. We send you an identification form via DocuSign. We don't want that form back until right at day 45. I don't want you filling out all your properties, a list of properties on day 5. It's a waste of your time. So between now and day 45, the only thing you focus on is just finding the one property you want. Write an offer. If you lose out, find another property. Write an offer. I don't need to know anything about that. And then if your exchange is going to go past day 45, because like I said, it may not. You might complete it before then. But if it's going to go past day 45, that's when you fill out that form on day 44 or day 45 and say, hey, here's the 3 properties I'm interested in. You're just naming the addresses. Maybe one of them you're in escrow and we already know about, right? And the other 2 are just backup properties and they're for sale. You wouldn't mind defaulting to them should you have to, right? And then you sign that form and that's the identification form. Yes.
So basically make a big list of all the properties you could want and send that on that form so you're covered in case one of them...
Depends on what you mean by big, right?
10 to 20.
Yeah, that's probably not going to work. Because you really there's 3 rules of identification, right? Which limit the amount you can actually identify. All of these rules were created to allow any exchanger the ability to name backup properties. So they can name more properties than they actually want to buy. So most people just are buying 1 or 2 properties in the 1031 exchange, the vast majority. So the 3 property rule works for them. That means you can identify up to 3 properties of any value. They could be $5 million a piece, right? You're capped at 3 properties. If you're going to go into your exchange knowing you're buying more than 3 properties, because it's not uncommon. You sell 1 very expensive property, you want to buy 6 little properties. It happens. But you can't use 3 property rule. Then you'd use the 200% rule. 200% rule has no cap on the number of properties. So 10, 20, 30, 100, right? But it does have a cap on the value. So everything you identify can't exceed 200% of the value of the real estate you sold. You sold a $2 million property, you can identify $4 million worth of replacement properties, no matter how many properties that ends up consisting of. Right, now, there is a 3rd rule. I will tell it to you. I want you to forget it. You'll never see it used, ever. It's the 95% exception rule. In my 29 years, I've seen it used twice. So this is the rule. This rule is for rebels. Who is a rebel? No, it's like people that are like, I will not be caged by your rules, Russell. So I'm going to violate the 3 property rule by identifying 5 properties. And I'm going to violate the 200% rule because those 5 properties are worth 400% of what I sold for. Okay, first 2 rules don't work. You have to now default to the 95% exception rule. That one states you have to close on 95% of what you've identified, which is like everything. I don't know why they didn't call it 100% rule. Because if you identify 10 properties, how many you got to close on?
9.5.
Yeah, kind of tough. 10, right? So if you don't close on all 10, your entire exchange fails. It wasn't even a partial exchange, right? The 2 times I've seen it used were very similar. That's where an exchanger was buying a portfolio of real estate from one seller. And that portfolio was more than 3 properties and more than 200%. They were either going to buy the portfolio or buy nothing. So it's a catch-all, right? You guys don't need to worry about identification, right? Because if you do get into an exchange, at that time, I'm going to help you decide which one of these rules are best suited for you. So here's the other thing. This is the math of the 1031 exchange, equal or greater value. Because people ask me all the time, how much do I have to buy? Like I'm selling for this much, I owe this much, I bought it for this much. Stop, woe, and ho. None of that matters. There's 3 things that have to be equal or greater. Let's say I sell for $1 million and I buy for $800,000. By a show of hands, how many think that that's a failed exchange? How many think that's a valid exchange?
Repeat that, please.
How many didn't get, you had to raise one hand to the other. So if I sold for $1 million and bought for $800,000, right? Did I fail my exchange? The answer is no, I didn't fail my exchange. I have a valid exchange. I'm just going to pay tax on the difference, right? It's called boot in our world, right? Anything that you buy down in value, you touch any money, that's all called taxable boot, right? So if you don't want there to be, it's okay to buy down in value, but just understand you're going to pay taxes on the difference. If you don't want there to be any tax, no boot from your exchange, you want to defer it all, 3 things have to be equal or greater. First is sales price. So what are you selling for? Selling for $1 million. Okay, you don't actually have to buy for $1 million, technically. There are some subtractions allowed. You do get to subtract those one-time traditional closing costs. Realtor commissions, title escrow fees, transfer tax. All that stuff gets subtracted. So let's say you sell for $1 million, those costs were $100,000. $900,000 is the actual equal or greater. You need to buy for to defer all tax. Right, so that's the first thing, is sales price. Second thing is proceeds. That means when the property you're selling closes, after the loan payoff, after all the fees are taken out, what's left? That's the proceeds. All proceeds must be reinvested into the replacement properties. Any proceeds you receive yourself are going to be taxable. Once again, it's okay to do. It's okay to say, I want 50 grand out of my exchange. Just understand you're going to pay taxes on the 50 grand. It's not going to, you can't write off against basis on it. It's going to be capital gain. Yes?
Is that 25%?
Whatever, right? It depends. Well, good question. It depends on what you sell, right? So if you sold a raw piece of land, there's not going to be depreciation recapture, so it's going to be 15 to 20%, right? If you're selling an improved property like a rental, so the boot you're taking out, you're not taking out all the tax, all the gain, you're taking out a part of it. So the part you take out is taxed at the highest rate first. So depreciation recapture, 25% is first. And then once you've recaptured all the depreciation, or ordinary income if you've done cost segregation, and then the rest is taxed as capital gain. So the first dollar you take out is the most expensive tax, right? You want to talk to your CPA before doing that, just so you know what that tax hit's going to be. There's personal information involved in it. Yes.
How does the land value affect the boot? Or does it?
It doesn't. Your basis flows through into the replacement property, and the land value acquisition of the land is part of your basis. So that's going to go with you into the property you're buying.
Even if the land value increases?
Well, that's just a new basis then.
Oh,
Right? If you're buying,
you can't use it to
value.
offset at all.
Not offset. It's not, if you're taking boot out,
Yeah.
you can't use basis to offset. First dollar you take out, they're going to tax it as a gain. Period. End of story. Part of your profit. So third thing that has to be equal or greater is debt. That one, just from a math standpoint, kind of makes sense, because if I'm selling a $500,000 piece of property and there's a $250,000 mortgage still on it, Well, when I sell it, the mortgage is paid off. Now there's only $250,000 in my exchange account. And I have to buy for $500 again to be equal or greater. So how am I going to do that? Typically, I'm going to take on a new loan, right, to be able to buy that expensive equal or greater property. There's an exception to that rule, as there always is, and that is you can replace debt with outside cash. So same scenario, sold for $500,000, $250,000 was a mortgage payoff, there's $250,000 in the exchange account. I buy a property for $500,000 to complete my exchange. It just so happens I have $250,000 sitting in a savings account. This isn't a true story. So I bring in the $500,000. I buy my $500,000 property all cash. Fine. You replace the debt with outside cash. You can do that. You don't have to take on debt. Don't work. And so really, if two things happen, to make all this math simple, if two things happen, you never pay tax. Buy and sell for equal or greater value. Do not touch any money. If those two things happen, this math just falls into place, and you will defer all tax. Any questions on that? Cool. Let's get past that. Now let's get into the fun stuff. Like kind. So, who here has never been involved, by show of hands, who here has never been involved in an exchange yet? Keep your hands up. Who also has not been to a 1031 class before?
James.
James, you have not been involved in an exchange.
Correct.
Excellent. You've not been to a class.
This is the first.
Perfect. Have you heard of a 1031 before tonight?
Yes. It's part of my
Have you heard-
education.
Excellent. Have you heard this term like kind?
No, that was not.
You are
part of
so
this.
perfect for this question. Awesome, James. And thank you for volunteering, by the way. So James, in a 1031 exchange, you can sell real estate and buy real estate, right? And defer all the tax. But the key is, both properties involved in that exchange, they have to be like kind with one another, like the one you're selling and buying. Okay, so James, let's say you have 5 acres of land, nothing on it, just flat ground. You'd like to sell that land, and you'd like to buy this beautiful commercial building. Would you say those two are like kind?
No.
High five. You're 100% wrong. Thank you for explaining. You answered in total common sense. That's why I ask people that are not familiar with 1031s. If I was not in the industry, I'd answer exactly how you answered. Right? 1030, it's a misleading term, like kind. It's not what a property looks like that makes it like kind. It's how it's treated for tax purposes. Any property that's treated as a business or investment property is like kind. That's huge. That means you can sell raw land and buy rental property. You can sell a rental property and buy commercial, industrial, mini storage, right? It's all interchangeable. It is all like kind. That's huge, especially from a financial planning standpoint. James is 5 acres of land, for our example here. Does he have any income coming off that?
Maybe. Probably not.
Maybe.
Probably not.
Well, it depends on what he's growing. We all know James. By the way, he makes killer brownies. So he has no income coming off the property. He also can't depreciate. There's no improvements on it. So it's a negative cash flow vehicle. And no income coming in, but there's expenses going out on it. I don't know, what's the property worth? $300,000. That's $300,000. It's what we call in the financial world stagnant equity. You have $300,000 provided with zero income, zero depreciation. You can do an exchange. You can sell the raw land and you can buy a rental property. Now you have an income property where you're receiving income off of your equity. Now you can depreciate the structures and help offset the income from that asset. And in a lot of cases, maybe you have a faster appreciating asset too. You can do that entire transaction completely free using the equity from the land and the 1031 exchange. I can't count the number of times I've had CPAs tell my clients, you can't exchange raw land for an improved property. It's not like kind. 100% false. Never been true. Right? So that misconception is out there. But first let's finish on this. So all these asset classes you see on the screen are like kind and they are all interchangeable. This is why the 1031 is such a powerful wealth building tool. Right? Because if you look at all these different asset classes, for the most part, they have a little bit different financial objectives. So as your financial objectives change, the 1031 allows you to pivot right to that kind of asset that better suits your current financial objectives because they're all like kind. But if it's all like kind, why even have that term like kind? What do you think?
So you don't do it for personal property.
Yes, good call. So there are a lot of things that are not like kind. In like kind, before the Jobs Act in 2017, we used to be able to do 1031 exchanges on assets other than real estate. Anything you held for business or investment purposes was exchangeable. A farmer selling their tractor, selling a pilot selling their plane, fishermen boats, fleets of vehicles, livestock, arts and collectibles. Anything you held for business or investment purposes was exchangeable. Jobs Act changed that. Now only real estate is exchangeable. I have a picture of a saber-tooth tiger skull on there because I actually did an exchange for a client on a saber-tooth tiger. It was a funny story. It was a Montana person. They called me and they said, they were asking about this exchange. They're like, hey, she sent me a picture of the, this is not the picture of it. This is very similar, gorgeous fossil. She'd owned it for many years. It tripled in value. And she wanted to sell it, and she wanted to buy a mammoth fossil that she found. And so she called me and she said, hey, are they like kind? And I said, well, the IRS didn't have that kind of foresight, really, to put everything in their list of what's like kind. So it's kind of open to, definition of whatever your tax advisor agrees. So I said, what we should do is let's get your tax advisor on a conference call. And I will explain to your tax advisor why I believe it is like kind. But they have to give you the green light. So we did, and we're on a conference call. The CPA, the client, me, about 5 minutes into my spiel, explaining why it is like kind, why I believe it's like kind, the CPA shuts me down. She is angry. She's like, Russell, we need to stop this conversation right now. Whoa, what's wrong? You are putting my client in danger. What? She goes, I am quite certain that what you are telling my client to do is absolutely illegal. What do you mean? She goes, I know for a fact that the saber-toothed tiger is on the endangered species list.
Wait a minute.
No, I think it moved to the other list. Extinct. Yeah, the EPA, I think they checked that box, I think it was like 11,000 years ago, right? No longer alive. Last one died in the zoo. We're good. So I didn't see anything on the phone, but I was thinking, you need a new CPA.
Yeah.
But I was able to, no, they're extinct, we're good. It's not endangered, so we're fine. But all of the things you see on here are not exchangeable, right? In the upper left-hand corner, partnership interests. You cannot exchange into a partnership interest. A partnership can do an exchange. Any tax-paying entity can do a 1031 exchange. S Corp, C Corp, LLCs, whatever. They can all do exchanges. It's just that whoever the taxpayer is that sells must be the taxpayer that buys. So if we are in a 3-member LLC together, and you guys want to buy me out, why do you guys want to buy me out? You can be honest.
They don't like you anymore.
Thank you very much. You've been in a partnership with me. So yeah, they don't like me. They want to buy me out. My buyout is not exchangeable. It's a fully taxable event. Same thing, I can't sell a rental property and do a 1031 exchange into their partnership. I can buy into the property as a tenant in common with their partnership. Just can't buy into their partnership. I bring this up because it's common for investors to sometimes pool taxpayers when it comes to owning investment properties. So maybe you have 3 buddies in an LLC and you invest in real estate. Keep in mind that someday you might not want to be in the same LLC with them again. You might want to go your separate ways for whatever reason. If that's the case, you can't sell as a 3-member LLC and buy as an individual. It's not allowed. So you're going to need to call me in advance of selling to help walk you through your options. Yes?
If I have an LLC set up to own that ownership interest in that partnership, you couldn't do it?
What do you mean?
You have a separate entity to own so you have a partnership that owns the property, but you have an LLC that owns that interest.
This is a member. So your LLC is the member of the land partnership. So it's still the taxpayer of record that owns the property for tax purposes is the parent LLC.
Right.
That's the exchanger.
That's the one that has
Not the members. Not the members.
Not the
So it's the same thing, right? Now you can. I'm not saying this because you shouldn't have LLCs because, yeah, if you own investment properties, if you want the liability protection, own it in an LLC. But if it's a single member LLC, like it's you and your spouse, or just you, that's a disregarded entity for tax purposes. It doesn't file a tax return. The individual is the member is the taxpayer. So you can sell as a single member LLC and buy as an individual. That's fine. You just can't sell as a multiple member LLC and buy as an individual. So you'd want to drop out of that LLC in advance of selling the property, and then make sure that you season that a little bit for a year or so, and then sell the property. There's other ways too, but nevertheless, the most important thing, if you are in a partnership and you want to go your separate ways and sell an asset, what are you going to do?
Call you.
Call me. That's the most important thing you learned tonight. My phone number. When can you call me? Anytime. Very cool. Yes.
Before you do anything.
Yes, please. Don't tell me after the fact. Yes.
Do you have a recommended seasoning period for a drop and swap?
Yeah, so that's what I was kind of alluding to, was a drop and swap. What he mentions is a kind of technical term and it's a nickname. So if the three of us are in a 3-member LLC together, what was a common practice in the past was we would go ahead and we'd be in contract to sell the property. And prior to closing, we would dissolve the partnership, deed out our individual interests as 3 tenants in common on the property. And that way the 3 of us are owners when they actually sell instead of the LLC. And then we would sell and go our separate ways with a 1031 exchange. It's called a drop and swap. You drop out the partnership, swap using a 1031 exchange. The problem with that now is 14 years ago, the IRS changed the partnership return. That's the 1065 form.
Yeah.
1065 form was changed. They added 2 questions. Bless you. That's on your sleeve. I'm just kidding. Maybe look. They changed. They added questions number 13 and 14. They ask you, basically, to paraphrase, it says, did the partnership deed out any interests in the real property to any member as a tenant in common, either a year before executing a 1031 exchange or a year after executing a 1031 exchange? So it's a drop and swap or a swap and drop, right? So now the feds ask for that. And they're saying a year. So if it's over a year, you don't have to check the box. If it is under a year, you got to check the box. Now that being said, when the IRS put 1031 on the federal tax form for partnerships, to us, that's like, oh my God, that's a red flag. So we approached the IRS, we asked them, should we be telling our clients, don't ever do drop and swaps again? You know what they told us? What do you think they told us?
What's that?
Yeah, that's actually accurate. No, they said, no. You can still tell. We're just collecting data. Yeah. So we were suspicious. So we told our clients, you should probably wait a year so you have to check the box. Since then, to their benefit, they really haven't. We have not seen the IRS aggressively using the 1065 form to audit and fail exchanges. They haven't. But we have seen a couple states use that form to audit and fail exchanges. Anybody want to guess those 2 states?
California.
How did you guess that? What's the other one?
New York.
New York. Thank you. The bookends, the crazy bookends, right? Yep, absolutely. Those 2 states aggressively use the 1065 form to audit and fail exchanges. The state of Nevada does not. So if you don't need to wait a year. There's no mandatory requirement to wait a year. But I would recommend this. Do the drop before you're in contract to sell. Before you have an executed purchase agreement with a buyer, do the drop. It doesn't matter if it's a couple months before you sell. Just don't tie the sale to the drop, right? But it's really what it comes down to is whatever your tax or legal advisor agrees is a safe.
If you're in an LLC and you own more than 50% of that LLC, can you exchange your portion?
No, because you're exchanging out of a partnership interest. It's the LLC that's the owner, not you as an individual. So your interest, no. So the LLC has to sell and buy. So you got to do this drop if you want to do an exchange with your interest prior to selling. Okay. Spend a little bit too much time on the partnership stuff here.
Yeah, I'm going to ask you the same question for the 3rd time. I see it says primary residence.
Yep, I'm going to talk about that right now.
But my question
keep
is
saying.
it's not primary.
Like secondary?
Yes.
Same thing. So primary residence. So let's talk about these are things that don't qualify 1031, right? And one of those is a primary residence. But really what we mean is a personal use property. A personal use property doesn't qualify 1031. So a second home that you don't rent out, it's personal use property. Right? Primary residence, personal use property, doesn't qualify 1031. Right? So and that's fine because if you second home is not fine. Your primary residence is fine because you already have a wonderful tax benefit when you sell your primary, right? That is called Section 121 of the Internal Revenue Code. And that's where if you've owned and occupied for any 2 out of the last 5 years, you get to exclude a certain amount of gain. So if you're single, where are single people? How much do single people get?
250.
Where are married guys in your room? Any married guys, raise your hand. How much do you get?
5.
No. No. You get 0. And she gets 500. You're just going to be happy. So, actually, what it comes down to is everybody gets 250. Right? Because if the 3 of us as buddies own a house together, we each own it, we each occupy it, we each get 250. A married couple is one taxpayer when they file jointly, so that's the only one taxpayer that gets $500,000. So because of this wonderful exclusion, Section 121, most people don't want to do an exchange anyway on a primary because it's a tax-free sale. But a lot of people would like to do the opposite. Use a 1031 exchange to buy a dream home. Right? Sell a couple of my rental properties or a piece of land. I would be killed in taxes if I just sold them. I can do an exchange, use the exchange to buy my dream home. Right? The IRS created my absolute favorite revenue procedure back in 2008. It's 2008-16. It is my favorite revenue procedure because it is a safe harbor. This is the IRS telling us exactly how to use a 1031 exchange to buy our dream home. And if you follow this simple recipe, they can't challenge or overturn your exchange. It's a safe harbor. That's huge. This is why it's my favorite revenue procedure. I read it every night before I go to bed. It gives me very happy dreams. So here's the revenue procedure. Sell your investment properties, buy your dream home with the 1031. For the first 2 years, this is the time period. For the first 2 years. And by the way, this is going to be the same seasoning to make a second home qualify for 1031. Okay? So I buy my dream home with the 1031. For the first 2 years, I have to treat the property 2 ways. I have to do both of these things. Not just one or the other. The first thing is I have to limit my personal use to 2 weeks a year or less, or 10% of the rental history each year, whichever is a bigger number. So if you rented it on Airbnb for 300 days a year, you could use it personally for 30, right? Now, by the way, if I'm going there to work on the property, is that a personal use visit? It's a maintenance visit. You can have those in excess of the 2 weeks a year, right? So there's ways to use it, right? It just can't be your primary. And you got to limit your personal use. The second thing you have to do is show income on it. But that's a crazy low standard. You only have to show 2 weeks per year of income on it. That's crazy, right? So wait a minute. I can sell my investment properties. I would have been killed in taxes. I don't have to pay any taxes. I can use all that money to buy my dream home. And all I have to do for the first 2 years is limit my personal use and find a buddy to rent it to for 2 weeks a year. Yes, that's all you have to do. I don't have to have it listed on VRBO or Airbnb. I just have to show 2 weeks a year of income on my tax return for that property. I just have to do this for the first 2 years. After 2 years, I can do whatever I want. I can move into it as a primary. I can treat it as a pure second home or vacation home. I never have to rent it again after 2 years. And if I have a second home, because second homes, if I own a second home already, second homes are in what I call purgatory. Right? They don't get the benefit of 121. It's not your primary. They don't get the benefit of 1031. It's a fully taxable sale.
When do you start renting it?
Start renting it. So for the 2 tax years prior to selling it, get the 2 weeks a year of income on it. Limit your personal use. Now it qualifies 1031.
The Augusta rule where you, as a business owner, can rent out your house for 14 days, and could you do that with this?
Rent out your house for 14 days.
Yeah.
So you live in the whole house year round,
No.
and then you rent out it for 14 days a year. So are you talking about you bought a residence and you're renting it to your business, or your business bought the house and you're living in it and renting
So,
it to them?
for instance, we do events, and we can rent out our house. Our business rents out the house to do events at the house. So I'm just saying, if you're
But you live in the house the rest of the time.
Yes.
You live in the house all the time. You don't move out for the events, right?
Correct.
That's called a mixed-use exchange. Like part of the property qualifies 1031, part of the property qualifies 121. It's a mixed-use exchange. Not the whole property doesn't qualify. Just part of the property qualifies. They use for business use, which is good if you're in excess of your 250 or 500,000. It's a way to get rid of that excess gain. Yeah, whatever your CPA is cool with, right? It doesn't matter to us, right? So your CPA says that's cool. It's not uncommon for people to do stuff like that. So but that means you're gonna be taking depreciation on your primary residence, right? So, which is a great tax benefit. But when you sell it, just keep in mind you're gonna have to do an exchange to eliminate that tax, right? So let's go right to that mixed use exchange. Yes.
So if I sell 5 rental homes that I own, buy the fancy home, get the minimum rent for the 2 years, then I move in, spend 2 years in it, then I walk away from all the gain that I had on my previous homes, or
You are such an optimist. You're so sweet. No, it doesn't work quite that way. I mean, I like your thought process. You have a good heart. You'll never be able to work for the IRS. You're way too nice. So that doesn't quite. But let's walk that scenario out.
Okay.
So because a lot of people want to do that because they want to cash out. Because if you cash out in an exchange, you're going to pay tax. So they say, well, I want to cash out some of my real estate, so I'm going to convert it to a primary and cash out that way. Okay. So here's the deal. So use this safe harbor. Sell your investment property, buy your dream home. For the first 2 years, rent it out. After that, move into it. Now, normally, you only have to live in a primary for 2 years to qualify under 121. In this case, that is not the case. You have to own it for 5 years. Because you bought
so that would make it 3 years living in it.
Yes, rent it for 2, live in it for 3, rent it for 3, live in it for 2. But you have to own it for 5 because you bought it with a 1031. You deferred taxes into it, and now you want to sell it under 121 and eliminate a lot of that tax. 5-year minimum hold to qualify 121. Now, the big question is, and that's what you're asking is, do I get my full 500? The answer to that is maybe. Because what happens is you get a prorated share. I'm going to change the numbers. Let's say I buy that property with the exchange, I rent it for 3. And then I move into it and I live in it for 3. And then I sell it. I've gotten past the 5 years, so I can sell it under 121. Well, now when I sell it, I have to create this proration. So I have to look back on all 6 years that I've owned it and define each one of those years into one of 2 categories, either a qualified or a non-qualified year. I'm trying to sell it and pay no tax. So a qualified year is a year I lived in it. A non-qualified year, it was either rented or vacant. So in my case, that's 3 and 3. So that works out to be 50%. So let's say when I sell it, there's $800,000 of actual gain in that property. I get to exclude 50% of that gain, $400,000, up to my $500,000, right? So if it did have $1 million of gain, I would get my full $500,000, right? So the longer I own that property and the more I live in it, the better that calculation works for me. If I own it for 10 years and live in it for 8, 80% of the gain comes to me, up to my $500,000, right? At no point will that be a tax-free sale. You'll eliminate a lot of the tax. You can. You'll just never be tax-free. There'll be some tax.
This is gain from the purchase price, nothing to do with the prior properties you exchanged.
Yeah, because you deferred tax into it. Now you have a lower basis than what you actually bought it for. Right, so it's a total gain. Yes.
Is there anything above 500,000 you're going to be taxed on for personal?
Anything above $500,000 is going to be taxed on.
Yeah.
Yep, that's capital gain. Right. Yeah. So it makes sense to do still. You may get some benefit there, just not necessarily. You're not going to eliminate all the tax. Right. So let's talk about this mixed use exchange. So that's when we're talking about a property that has multiple uses. You live in it, but you also have a business use. Right. A duplex would be a common example. You live in half and you rent out half, right? Okay, when you sell it, if both square footages are identical, then half the sales price will come to you tax-free because of Section 121. Half the sales price is that equal or greater mark you need to buy for investment properties in order to defer the tax. So you eliminate some of the tax and defer the rest of the tax, right? A duplex is easy to calculate. Something else that'd be more complex, maybe an in-home office. Since COVID, who's been taking this deduction? A lot of people, right? When you sell a primary residence and you have an in-home office in it, guess what? You're going to pay some tax, even if you're within your $500,000. Because that Section 121 we've been talking so much about is an exclusion of gain. Gain is based on the appreciation. It is not an exclusion of the recapture of depreciation. And remember, that's a heavy tax. That's 25%. So Whatever you've depreciated in that property is going to be taxed unless you do an exchange on that portion. So how do we figure out how much to allocate? It's actually pretty easy. You take depreciation, right? You write off a bedroom. The bedroom's 15% of the total square footage of the house. So you're taking 15% depreciation. So 15% of the sales price needs to flow through a 1031. 85% of the sales price will come to you tax-free under Section 121. Right? That's in the house. Now you also have detached structures. We used to call them mother-in-law units. Oh, sorry, it's a typo. So maybe they're detached, the same thing. That's what's the square footage of that versus all the square footage. Well, if that's 30% of the square footage, you need to do an exchange on 30% of the sales price, right? And now primary residence on acreage. This one's kind of cool. Let's say I buy a property 60 years ago for $100,000. It was 100 acres with a house on it. When I bought it 60 years ago, it was in the country. Now, it's not in the country. Cities come to me. My 100 acres are now subdividable and for residential lots. I bought it for $100,000 60 years ago. How much is the house and 100 acres of subdividable land worth now? More. so let's say, I don't know, pick up a number, 5 million, right? Okay, well now, how good is my capital gain exclusion to me? Not so good. I have a $100,000 basis, comes back to me tax-free. I get $500,000 of gain, $600,000 tax-free. Woohoo! I'm selling for $5 million. That's what, 4.4 fully taxable. Ouch. That's a lot, right? I can do an exchange, a mixed-use exchange. And it doesn't matter the property, you've never farmed it, you've never ranched it, you've never earned a penny of income on it. Doesn't matter, still qualifies 1031. Doesn't need to be income producing to qualify 1031. Your intent must be to hold for business or investment purposes. If I hold raw land, I hold it for appreciation. Valid form of investment, qualifies as like kind.
Is there a minimum lot size for the acreage?
There really isn't. Obviously, the bigger the better, right? Because the more defensible. But it really comes down to is you're going to need to segregate out the values. So call your realtor and say, hey, I need 2 brokers' opinions of value on this sale. We're selling for $5 million. What if my house were just a standalone on an acre? What would that sell for? Comps come in at $1 million. Okay, if the 99 acres were to stand alone of subdividable land, what would that be worth? That's the $4 million. Okay, now I've got my allocations, right? I'm going to take $1 million at closing as my primary residence, pay a little bit of tax, and then I'm going to defer $4 million through IPX and buy replacement properties, providing income for the rest of my life. Right? So really, whatever is defensible on the acreage, whatever the CPA, because you got to get your CPA involved in this. They got to agree that this, whatever you're using is defensible should they ever be audited. So. Pretty cool. Mixed use exchange.
Very cool.
Yes. Inventory properties. This is the other type of property that does not qualify 1031. An inventory property is defined by the IRS. If the real estate you own, if every day you own it, you are trying to resell it, it's considered inventory property. To qualify 1031, your intent must be to hold for business or investment purposes, not for inventory or resale. Well, give me some examples. Who would be, what's that? Flipper, exactly. Flipper. Builders, buy, subdivide, build spec homes, sell, no matter how long it takes. Flippers, buy, fix up, and sell, no matter how long it takes. That's inventory property. It doesn't even get capital gains treatment. That's just taxed as ordinary income, right? Because that's just income. I get this question a lot from flippers. They'll say, hey, I heard about this 1031, right? Should I be doing a 1031 on my flips? I just ask them one question in return, and that is this. Mr. and Mrs. Flipper, do you need the money from your flips to live on? That's all you have to ask them. Right? If they say, well, yeah, that's how we pay our bills. Okay, don't even think about 1031. Just flip to your heart's content. You're going to pay in tax on the income just like the rest of us do on our income. But some people will say, no, we don't need the money from our flips to live on. It's a side hustle. We do something else for a living. They're a teacher, they're a fireman, they're a policeman, right? They want to roll 100% of that equity into the next flip. Oh, okay, well they need to alter their strategy. So instead of buying, fixing up, and selling, they're going to buy, fix up, and what? Hold. More specifically, rent. That establishes a hold intent. A builder, never going to rent a spec home. A flipper, never going to rent a flip. So when you establish that rental history, you then crossed the line from being a dealer to an investor. Dealers don't qualify 1031, investors do. Yes?
How long do you have to rent it out for?
Ooh, good question. What do you guys think? How long?
2 years.
2 years? What? Anybody else want to guess?
1 year.
1 year?
2 weeks.
2 weeks? I would call you an aggressive taxpayer. Actually, you're all right. There's no stated time period. The IRS has never created a revenue procedure that states this is how long you have to hold a property before you can sell it and do a 1031 exchange. And let me be very clear, they never will ever create that revenue procedure. It's more about intent than time. Yes.
There are some builders that are building out, specifically in Fernley, but I know there's other areas that they're building, D.R. Horton and a few others, where they're actually building them, renting them out, and then reselling them.
Yeah, so those assets potentially qualify for 1031
Interesting.
because
And that could be what they're doing.
yeah. So, but the question is like, how long should they be renting the property? Or whatever. There's no stated time period. I follow case law in the industry. I can show you case law where clients have held properties for as short as 3 months and had a valid 1031 exchange with a huge gain. I can show you case law where they've held for 5 years and that was disallowed. So 3 years, 3 months was okay. 5 years was not okay. That tells you time doesn't matter. And just so you kind of better picture this, the 3-month case law, very interesting case. This is a true case. I forget the taxpayer's name. We'll call him Bob. Bob bought a property on the border of a residential area. He wanted to locate his business inside of this structure. The zoning laws were perfectly legal and fine for his type of business. But the neighbors that live right there, they didn't want that business anywhere near their homes. Anybody want to guess what that business was? Marijuana? No, they totally wanted weed. They had kids. They're stressed. What's that?
Childcare.
Childcare? Well, we have a kid hater. No.
Rehab?
no, not childcare. What's that?
Rehab.
Rehab? Not rehab. Prostitution? Nope. I said legal business.
Depends what county you're in.
Well, it depends on what county you're in. Very good. We're in Nevada, where sins are legal. What's that?
Dog kennel.
Dog kennel. Nope. You guys are all close. It was like, I forget the name, it was like Bob's Palace of Pornography.
Nice.
Right? Yeah, nice. so the neighbors didn't want that in their neighborhood.
Video camera.
So the neighbors formulated a plan. They approached Bob and they said, Bob, you bought for X amount of dollars. We, the neighborhood, will buy you out of town for 200% of what you just bought the property for 3 months ago.
Maybe that was his
200% profit in 3 months?
Bob said yes.
Yeah, Bob said yes. I'm pretty sure, exactly. Bob said, I have a new business model. I'm going to buy properties, scare the hell out of the neighbors, force them to buy me out. I never have to actually open the porn shop. Fantastic. That'd be a good reality show. Flipping porn. Very cool. So he did an exchange on that. The IRS, of course, told him no. Because on paper, what he looked like? 100% flipper. He never opened a business there. He had to turn 200% profit in a short time period. He appealed and he won. He beat the IRS because he proved 3 things. He never held the property for sale. He was approached unsolicited. He had a long-term business plan in place. He proved his intent, right? Person held for 5 years, they were disallowed. They put the property back up for sale the entire time they owned it. It's called an overpriced listing. It took 5 years to sell. That's inventory property the entire time, right? So, shorter answer to this long story already, how long should you hold it? Most people agree a year. Buy a property, fix it up, get some rental history into it, sell it after a year, own it in total for a year with some rental history. You should be fine, right? Yes.
So I've had houses that I've legitimately tried to flip, they didn't sell, and then I turned them into a rental.
Yeah.
Being honest, like how long would I want that to be a rental?
Own it in total for at least a year. You don't have to rent it for a year. Own it in total for at least a year. I mean, check with your CPA because there is no stated guidelines. Certainly, the longer you hold it, the better. But most CPAs agree 1 year seems to be safe.
What if you just go ahead and buy the thing and then do like an Airbnb for a summer or a quarter or something like that?
Sure. Well, I mean, you fall in the safe harbor, right? If you rent
Yeah, I
it
was
out for
gonna
2 weeks
say
a
that.
year, you're good and don't use it yourself personally, then it qualifies 1031. So you don't have to rent it full time.
So if you're making enough money and you sell it and then you go, I'm gonna Airbnb it for 3 months for the summer, then it's classified because I made income off it and then
Yeah.
turn
Should
it
be
and
fine.
sell it.
Should be fine.
to flip.
Should be fine. So let's get past this. We're getting short on our time here. So 1031 is federal. You can use the 1031 to cross all state lines. People leave states for various reasons. California, they leave for obvious reasons. But you know, some people live in Nevada, they leave too, right? For a lot of reasons. Maybe the kids moved to Alabama, so now they're retired, they want to be closer to the kids. So they sell, but what I see is a lot of people leave states personally. What I mean by that is they sell their primary residence in Nevada, they move to Alabama, and they buy a primary residence there. They still own investment properties here. My question to them is always, why? Why do you manage from 2,500 miles away? And the reason is because they don't know, right? Nobody's told them. 1031's federal. You can cross all state lines. You can sell in California and buy in Nevada. I'm sure that hasn't happened yet, right? So, and defer state and federal tax, which is super cool. So you can sell your assets. If you move to Alabama, bring your assets with you, right? And man, the math works out every time. You can sell one rental property in the greater Reno area. And with those proceeds, you can probably buy about half of Alabama. You can own Alabama yourself, right? It'd be very cool. So, question?
It's U.S. only though, right? You can't move the money
Good
out
question.
of
So yeah, well, it's not U.S. only. You can do foreign exchanges. But as a U.S. taxpayer, I can sell foreign and buy foreign. I can sell my property in Canada and exchange into Mexico and avoid U.S. tax. So I can exchange foreign for foreign. I can exchange domestic for domestic. I can't mix the two. So I can't sell in Nevada and buy in Mexico, right? But that's a good question. So 1031 is federal. So estate planning. We had a gentleman that came into my office. This was, 20 years ago. He was 99 years old. How do I know that?
He told you.
That was when he told me. It was like the first thing he said when we walked in the office. I'm 99, come on. Do any of you announce your age when you walk into a public building full of strangers?
I was 99, maybe.
Damn straight. When I'm 99, I'm gonna wear a t-shirt. I'm 99, Dad, come on. I wear that everywhere I go. But he had a problem. He had one very expensive property. One piece of real estate, very expensive, and he had 3 kids. And he was planning his estate. What do 3 kids do if they inherit one very expensive thing?
Fight over it.
Fight, right? We use the 1031 to avoid the fighting, right? Pop sells the one very expensive property, goes to each state where each kid now lives. He calls them kids. They're like 75. He goes to each state where they live, says, kid number 1, what property would you like? He's like, oh, Pops, I've had mine on that property. So Dad does all the buying and selling, now owns 3 properties in 3 separate states near where each child lives, pays each child to manage that property for him, sets each one up in a revocable living trust. So when the inevitable happens, each child gets their property. They can keep it if they want. They can sell it if they want. They don't have to, talk to the siblings about it. They got the step up in basis, so they can sell it and pay no tax if they want, or they can keep it. So the 1031 is actually a powerful estate planning tool to use while you're alive to replan. Now this is, diversification, by the way, is the number one reason why people do exchanges. Right? They buy a property, build some sweat equity, sell that asset, use that equity to buy 2 properties or a bigger and better property, right? To increase your portfolio. Now on the backside, and this is kind of where we're going to spend the rest of our couple minutes here, is consolidation. That's something Ginger wanted me to get to. So it's very common that people buy real estate their whole life. And now they get to be retirement age. And the most common asset class that people buy is single family, right? So you bought your first single family when you were in your 20s because somebody said buy real estate, it's a good investment. You bought a fixer after 3 or 4 years, had some sweat equity in the property, some positive cash flow coming off it. You're like, this is cool, we're gonna do it again. So you buy another one, eventually another one, and another one. And now you get to be retirement age. Now you own 7 rental properties, free and clear. Right? When you first started investing in real estate, what was your primary financial objective? Was it cash flow or appreciation?
Appreciation.
Appreciation. I get really flustered when I see these real estate infomercials that say cash flow, cash flow, cash flow. Everybody must have cash flow. No. From a financial analysis standpoint, that is wrong. Right? If you are young and trying to build wealth, your primary financial objective should be appreciation. Cash flow is a consideration. Super important to make sure that you are getting the cash flow that you need. It is an important part of the analysis. It's just not the primary financial objective of that asset that you're buying. It's a secondary one, right? So single family, the primary financial objective of that asset class is appreciation, not cash flow. It's not. So if somebody's of retirement age and they own a bunch of rental properties, they're in the wrong asset class. You are. Because you're in an appreciating asset, not a cash flow asset. And when you go to retire, you've built wealth. You've built equity. Now it's time to pivot to cash flow. And what goes along with cash flow at retirement age is passive. You're tired of dealing with tenants. Right? They call it the triple T's. Tenants, toilets, and termites. Right? In commercial, you don't deal with that. And by the way, that's the asset class that is designated for cash flow. And if you want to go passive, then it's commercial triple net lease. That's the most passive form of real estate ownership. Tenant pays and does everything. You just receive checks every month, right? With no duties or responsibilities. The problem with that is if somebody's used to single family their entire life, they're in the wrong asset class, and they need to sell and pivot to commercial, triple net lease, that's daunting. It's like, whoa, I'm very familiar with single family. I am so not familiar with commercial. I'm out of my comfort zone, right? And that's where DST comes into play. Delaware Statutory Trust. This is what Ginger wanted me to talk about. This is DST was created, well, it was formally approved by the IRS in 2004, 21 years ago, right, as like-kind replacement properties in the 1031 world. So we have over 20 years of history in our world with the DSTs. DSTs were created to allow real estate investors to retire from active real estate, to go passive, so that all they do is just collect a check every single month with no duties, responsibilities, or any kind of maintenance expenses out of pocket, right? It's just passive cash flow. It's because what was happening is real estate investors that have owned for decades, they sold, they made a lot of money, so they got killed, so they said, well, we'll pay our taxes, because we made a lot of money. They got killed, and they gave up 25%, right? And then they put their money into like a CD, or a money market fund, and now they're earning 4 or 5% passive cash flow. You can do that with a DST. DST does that exact same thing. It's just you don't have to give up the 25%. You keep that working for you. What a DST is a fractional ownership interest in an institutional grade asset. Institutional grade means it's expensive. It's $100, $150, $200 million Class A asset. It's going to be an Amazon distribution center. It's going to be a huge climate-controlled mini storage. It's going to be a senior care facility. It's going to be a student housing facility on a major university, right? When you invest, when you sell your $400,000 rental property, you're buying into a fractional ownership interest of this $150 million Class A asset. You're just receiving monthly income. It's 100% passive, no duties, responsibilities, and no cash calls allowed either. That's the part I really like. Because if Amazon decides we need to restripe the parking lot, we need 10 grand from every owner, can't happen. No cash calls allowed. So, because some people will say, well, I'm already passive with my real estate. I own rental properties, I have somebody else manage it for me. I don't do anything. It's not passive, sorry. Because what happens if the roof goes out? Who's cutting that check? The owner. HVAC, hot water heater, you're still cutting all the checks, right? Can't happen in an DST. So it literally is 100% passive. It's not for everybody. There's really 3 reasons why people go into DSTs. Most common one is what we've just been describing. And that is, I want to go passive. I just want to receive 5% passive cash flow every month or whatever the number is, right? I don't want the headaches of real estate ownership anymore. The second reason, this was more common with the pandemic, or since the pandemic, and that is as a 1031 bailout, right? We said you only have 45 days to identify. Well, in a low inventory market, a lot of exchanges fail because you can't find something in 45 days. So at the last minute, they're like, we tried writing offers, we lost out every time. Now at the 45th day, we're just going to throw our money into a DST, save our exchange. When the DST resells in 5 years or whatever, we'll come back out and buy traditional real estate with another 1031 again. Right, so it bailed out my 1031 exchange. The last reason why they use it is as a sponge. What I mean by that, you sold a property for 1.5. You found traditional real estate for 1.3. What are you going to do with the other 200,000? You don't want to pay taxes on it? Okay, great. Plug it into a DST. Right? Yes?
Is that the average lifespan, 5 years?
4 to 7. These assets are going to be resold.
They're required to have a certain duration of time that they
Can't be over 10.
Yeah.
So because of the financing. So it's going to be, but 4 to 7 is, I've seen them sell in less than 2. But that should not be anticipated. When you go into one, you should be most people want to stay in it forever anyway, but you should be thinking 4 to 7 years.
Is there anything that probably has a worse return that be used for a shorter duration for a 1031 save?
Mm-hmm. Nope, there is not. You have to buy some other piece of real estate you don't like, right? And then wait till you can sell it, and wait till something good you like, and do another exchange a year or two later, right?
Well, and the other thing that this would work is if you had like 3, selling them all at the same time to get that much money to go into it.
Great point. Great point. If you're trying to offload 5 or 6 rental properties, and you're thinking, okay, I want to buy one commercial triple net lease property. Good luck in getting the 5 sold before the one closes. If this seller is going to wait for you to sell all those to other people, right? With the DST, you sell one, plug it into a DST. Sell another one, plug it into a DST. They're all doing the same thing, right? So yeah, it makes that much easier. Yes.
Okay, so how would I handle, let's say I got 10 single families, okay?
Mm-hmm.
I pop them all in there, but I got 2 kids.
Mm-hmm. Great question.
From estate planning standpoint, would it be a trust?
Yeah,
and then the successor beneficiaries of the trust would be the two other trusts for the 2 kids, one each? Or how would it be handled?
Yeah, so it's real estate, so it's really no different than your rental property that you own, right? So what happens is, let's use me as an example. Let's say I buy into a DST, and I'm in it for 3 years, and then I pass away, and I have 2 kids, right? And my kids I've named as beneficiaries, right, in my trust. So now what happens is when I pass, now all of a sudden the owner of the property is my 2 kids as tenant in common owners on my share. They got the step up in basis. They're each receiving 50% of the cash flow is going to one kid, 50% is going to the other kid, so they don't have to go to one person and fight over it, right? And now when the property sells in 3 more years or whenever, they just get the distribution of proceeds without paying any taxes. They don't need to do an exchange because all of my taxes were forgiven to the step up in basis. Right. So
the only setback is that they couldn't get their hands.
They couldn't sell the property immediately, right? When they inherit it, they've got to wait for it to sell, right? To liquidate it.
So it sounds like you can't just sell DSTs whenever you want. It has to be on some predetermined time frame.
So it's not predetermined. They're going to sell when the market's right. That's why I said it could be 2 years, it could be 8 years. But the average is around 4 to 7 in that window, right? And when it is right, when they do sell the property, they tell all the owners, hey, we just sold the property. It's going to be closing in 60 days. You all have 60 days to tell us what are you going to do with the proceeds. Are you going to 1031 with them into another DST because you love that passive structure? That's what most people do. Or are you going to come back to Reno and buy traditional real estate with another 1031? You have all the options available to you. And when it sells, the owners get all the equity.
So the DSTs, when they're selling it, they already have their plan to reinvest your money if you want to go along for the ride.
If you want to go along for the ride when that one sells, they will have another one teed up. Or you can go and buy another one. Because at any one given time, there's always between 40 to 50 offerings available with various companies. There's always a lot of DST inventory. You don't have to stay with them. You can exchange it for another DST if you want to, right?
And is that a class of shared investment that is regulated somehow? Because I know there's a lot of different people that talk about...
These are regulated heavily by the SEC. These are only sold through licensed financial advisors, and they're regulated by the SEC. So anything that you look at, any of these assets you're going to go into, you have to be given a private placement memorandum This shows you everything about that property, everything about the company that's selling it to you, what they've done every single time they've turned a property.
So they're, I mean, not in the exact same, but they're kind of like a real estate investment trust.
A REIT?
Yeah.
Similar, you can't exchange into a REIT. Because when you buy into a REIT, you're buying stock.
Yeah.
Stock's not like kind, right? It's not, you don't own the real estate when you buy into a REIT, but it has that same feel. And the asset is the same class. This is REIT class assets, institutional grade, right? These are 100 million plus assets. So it's the same class, just exchangeable, where a REIT is not exchangeable.
So back to your, back to the kind of the rules. If you had a property that had a loan on it, so you had $1 million property and you had a $500,000 loan, you go to exchange into a DST. Do you need to buy $1 million worth and replace that $500K?
Nope. These were created for the sole purpose of 1031. So all of the potential problems in a 1031, they created a solution for. One of those is debt replacement. So when a sponsor, I'm going to pick Inland. Inland Security's been around for 50 years. They're the largest DST sponsor company. They've done over 150 full cycle projects in their time. So when they buy a property, because they're always doing 10-year market research studies, right? What's the asset class that's going to do the best over the next 10 years based on whatever's going on in the economy? That's why I mentioned Amazon distribution centers, climate control mini storage, senior care, student housing, things like that, right? Those are great assets over the next 10 years. But they actually buy the asset first with their own money. And then what they do is they're going to only put in 50% of the capital. They're going to get a loan for the other 50%. Most DSTs are 50% leverage. Some are all cash, and some are highly leveraged. But most are right in that 50 range. So what happens is, if whatever cash you're bringing in, you're automatically assuming a 50% loan-to-value ratio without having to qualify. Because I have retired couples that don't qualify for a loan. You don't need to qualify for a loan. You're replacing the debt without qualifying for it. And it's non-recourse financing. So they can't come after you if it defaults for whatever reason. Right? So it solves that problem of debt replacement. So if you sell a property for $500,000 and it's all cash, when you buy into a DST, you're going to be buying $1 million piece of that DST. Not 500,000 because of that debt you're assuming also. With the debt. Which is actually good because like some people own rental properties forever. They've owned them for 30 years. You fully depreciated. You have no depreciation left. And you're selling that all cash. If you buy into a DST, you're automatically buying for twice as much as you sold for, which means you're taking on brand new basis, brand new depreciation. Because everything you bought in excess of what you sold for is new depreciation. So it's also a way to get new depreciation. Most DSTs have a debt component to it, so you're automatically assuming that debt without having to qualify for it. Which is fantastic. Works out really well. Yes.
Just kind of average rate of return on the DSTs?
So it varies. So like I said, these are regulated by SEC, so you always have to, you're given two types of returns they're going to quote you on. One is cash on cash. That's the income. Right, and I personally, as a financial analysis guy, I love that cash on cash. That's my favorite analysis number because that means whatever cash you're putting in, you can anticipate whatever they're quoting you. If they're saying 5% cash on cash, that's net after all expenses. That's what you can anticipate putting in your pocket, right? And so I'm actually, coincidentally, most traditional real estate is floating right now between like 4.5% to 6% cash on cash. It's funny, I talk to a lot of people that own rentals, and they're like, I make more than that with my rental. No, you don't. No, you don't. If you're not. No, I make $2,000 a month and rent on it. That's gross. Let's take some subtractions off there.
Yeah.
What are you paying in property taxes? What are you paying in insurance? You're California people, like insurance is stupid insane over there. What are you paying maintenance? Right, all those are costs. You subtract that out. Like I had a client and it was way up in Eureka, Northern California. A guy owns 5 properties. I was sitting down with him and his wife, and I was talking about this DST because he asked about that stuff. They want to retire. They hate their rentals. And I said, yeah, 5%. Probably. He laughed. He was like, I make way more than that. It's like, oh, you mind if I ask you some questions? So I started asking, what's this cost? What's that cost? He lost $2,000 on the property last year. He didn't gain anything. But because you think you're getting this income every month, you think that's my income. No, it's not. It's the net. Right, so you got to compare apples to apples. So it can be, the 4 to 6% range. You can also buy other types of DSTs. What are kind of non-traditional real estate is still exchangeable. Oil and gas leases. They might be throwing off 8 or 9%. Right? Those are exchangeable because of real property right. Oh, by the way, the second thing they quote besides cash on cash is the IRR. Right? So that's the total return. So you made 5% a year in income, but you maybe depreciated 5% each year also. So your total is 10%. Between the cash flow and the equity. Right? They quote both of those things to you.
Yeah. So for example, we have like 10 little regular rental houses. So let's say they're $500,000 houses. And how much does it cost to do an exchange?
Oh, how much do we charge?
Yes.
Oh, we don't charge anything. We just want a hug. It's just a simple flat fee structure. When you sell your relinquished property, there is going to be a $1,000 fee taken from the proceeds at closing, not until it closes. That $1,000 fee will cover the cost of the first relinquished property you sell and the first replacement property. If you sell 1 and 1, total cost $1,000. If you buy or sell multiple properties, that additional property after 1 and 1 is $350. Right? So yeah, just a simple flat fee structure. That's it. And we are the largest intermediate in the nation with the highest level of safety and security. You have to be careful in our industry because our industry is unregulated by the federal government, which is scary as hell. Right? Realtors are heavily regulated. Lenders, heavily regulated. Title companies, heavily. We, none. Yeah, your funds are held by us. We have title to your funds. Like, we can commingle. We can invest your funds any way we see fit to try to make money on your funds while we're holding it. I can take your funds to the local casino, put them all on black, and I'll be breaking no laws. God bless America. Any questions? Yeah, so you have to be careful who you deal with. We voluntarily put into place, because our parent company is Fidelity National Financial, largest title insurer in the world, Fortune 300 company. They make us put into place the highest level of safety and security, not just for your protection, but also for the protection of our stockholders and our Fortune 500 position. Because if one exchange flops and we lose several $1 million, that's bad for the stock. So we have the highest level of safety and security in the entire industry. $100 million Fidelity bond, $50 million performance guarantee, and $30 million of error and emissions. Also, we're very transparent. When your funds come into us, we create a segregated commercial bank account that we name you on as well, so you know we're not playing with your money. You will earn the interest on the funds while they're being held, not us. Don't get excited about that. These are liquid accounts, so they're like a checking account. So you're going to be receiving interest like you would on a checking account. But the big picture is you want those funds to be liquid, available, and safe. That's the priority, because you're trying to not pay thousands of dollars in